Welcome and thank you so much, dear faculty members, the dean, and the judges to join our fourth Merrill Lynch Wealth Management Center stock pitch competition. This is a very exciting event that we have been expecting for the entire semester. And for the students, I really appreciate your time and I appreciate your tolerance to my torture to you. I understand you got multiple deadlines to catch and you got many pretty, let's put that in a positive way, straightforward review opinions on your report. I understand that. And special appreciation to all the judges. And may I introduce the judges? And can you please say a little bit more about yourselves as I introduce? We have the chair of the Merrill Lynch Wealth Management Center Advisory Board, Mr. Jonathan Decker, with us today.
Yeah, hello, everyone. I am not only the chair of the Merrill Lynch Wealth Management Center Board, I also run the local Merrill Lynch office here in St. Petersburg with about 50 employees. I also have a personal advisory practice, which basically I started in Pennsylvania before relocating to St. Pete about 2 years ago. So I know how to deal with individual clients. And a little bit about how to lead people as well. So thanks, and I'm excited to be here for my third time.
Thank you, John. Thank you so much, John, for being with us, for contributing and advancing the mission of the center, of the school, and the entire university community. Students really benefit a lot from your contribution to our experiential learning. I really appreciate that. And next, may I introduce the Dean of the K. Tubman School of Business and Finance, Dr. Sri Sundaram.
Thank you, Dr. Don. Good evening, everyone. First of all, thank you to all the students who are participating, because this is really one of the things that I'm glad you have the opportunity where you're able to apply what the content you learn in theory and help you bridge the gap between theory and practice. And I really want to thank all the judges for taking the time out of your busy day to be part of this. I truly appreciate your efforts in joining this, and for all the faculty who have supported the students in this process. Thank you. Appreciate that. Looking forward to hearing.
Thank you, Dr. Sundaram. And next, may I introduce Mr. Charles Card. Mr. Card used to be the president of the CFA Society Tampa Bay, and Mr. Card is very, very experienced with student competitions. And here's a secret. He was the writer of several investment invitations and ethics challenge questions and answer keys.
That's right. Thank you, Dr. Dong. I appreciate the opportunity to be a part of this. This is my first opportunity to judge one of the stock pitch competitions, so I'm excited about that. As Dr. Dong mentioned, I recently served as president of CFA Society Tampa Bay. I spearheaded our ethics invitational event, which USF has participated in before and actually hosted the last time we did it live, so we appreciate that. Professionally, I'm an investment portfolio manager. I work with high net worth retail clients. My firm is Sable Trust Company. We are headquartered in downtown St. Petersburg, right on Central Avenue, and we manage about $2.7 billion in assets. Mostly, we do all of our investment work pretty much in-house. We invest in individual stocks, mostly large capitalization companies with a long history of paying and growing dividends. And we also invest in investment grade bonds on behalf of our clients. I'm excited to be a part of this group. When I was an undergraduate student back in the mid 1990s, I was actually on the other side of one of these presentations where I was the presenter. So it's kind of cool to be on this side of it now and be a judge this time. So thanks for having me.
Thank you so much, Mr. Card. And next, may I introduce Mr. Yans. Mr. Yans is a board member of the Merrill Lynch Wealth Management Center Advisory Board, and he's very experienced with portfolio management. Mr. Yang, can you please introduce yourself to our group? Mr. Yang, I think you are muted.
So, hello again. I was going to say that I'm the technology expert in my company, and I'm not doing so well the job there. So, forget I said anything about that. It was on mute, right? But I work at Doyle Wealth Management, which is a registered investment advisor here in St. Petersburg, Florida. We have 22 employees, and I'm the director of portfolio management here.
Great. Thank you very much, Mr. Yang. I really appreciate that.
I think you got muted automatically, Hushan. Sorry. Todd, I think go ahead, Todd. I think you got cut off halfway through.
Yeah, I think so. Yeah. I think Todd raised his hand. Let me. Todd, can you hear us? I guess.
No, we can't hear you, Todd.
We cannot hear you. He's working on some other technical problems at his company, I guess.
Todd, you're muted. Todd, you're muted.
Still muted. There we go. Ah, we can't hear you.
We can't hear you. Sorry.
Nope. Nope. Maybe we'll give a few minutes, Todd, and we can come back to you as you're working on. So.
Yeah, exactly. Yeah. So I'm leaving, it shows here. I guess he's re-signing in or something maybe. So and I would like to also remind that this entire event is recorded, and I would like to utilize this opportunity to also deliver our sincere gratefulness to our great donors, to our long-term supporters, and to all those school friends who make this event happen, to bring our students this very valuable opportunities regarding not only experiential learning, but also the real practice of the real world experience. Thank you so much for your generous support. And so if I may I move on to the detailed process of this event. And this event is very generously supported by two unsung heroes, Jamie Boyler and Terry Wissoff, who are in this meeting. And they are very great supporters and staff members for our school, and they set up everything to make this event happen. Thank you so much, Terry, and thank you so much, Jamie. I appreciate that. So we will be presenting 4 assets today, and Jamie will help us play the videos that you uploaded on YouTube sequentially, and each video, according to our requirements, would be approximately 8 minutes long. And after the videos are presented, one by one, the judges will bring their questions to the team that presented and recommended the assets correspondingly. And I would appreciate that, dear students, you utilize this opportunity, not only try your best to address the questions, but also try to learn from the other perspective. That is, as we mentioned multiple times in our lecture videos, a lot of times the value of a question is even more than the value of an answer. So try to think also from the judge's perspective, why that question is important as a part of your learning process. And each whole entire cycle of each pitch will take approximately 12 to 15 minutes. By the end of the 4 pitches, I would appreciate that the 4 judges send me your grading rubrics, so we will announce on spot 2 awards, the Best Presentation Award and the Best Analysis Award. Are there any questions? Okay, great. So Jamie, would you please help share the screen and play the first video of today's presentation?
Yep, I will get that up.
Thank you so much.
Hi, my name is Rafael Dogo. And my name is Jackson Andrew. And we're going to talk about Verizon Wireless. So we currently see Verizon Wireless as a buy. We do like the stock. It, of course, operates within the telecom industry and has, as you can see there, above average dividend yield of 4.3, and it has an average price of around $58 to $60 right now. A quick mention about the telecom industry. It's been integral to the market for about 150 years and is responsible for many of the technologies that we use today, including phones, radio, and television. It's known as a high value industry and is worth over $1.75 trillion today. In addition to being a high value industry, it's also a high growth industry. As we've seen in recent years, subscriptions are on the rise, as well as revenue and net income. We're going to talk about some opportunities. The first is 5G rollout. So to meet current and future needs for higher data speeds, as well as better quality voice communications, Verizon has put a heavy focus on the rollout of its 5G technology. Recently, the company spent $53 billion to purchase C-band wireless spectrum licenses, and these licenses will really help the company develop its 5G network in the United States and also increase its portfolio. With these new C-band licenses, Verizon will be able to offer its customers faster connectivity, and it expects to use this technology to cover over 100 million customers within the next 12 months. So due to this increased coverage, Verizon expects to increase its service revenues by 2% in 2021 and by 34% over the next couple of years. This is something investors should feel optimistic about because the company's service revenues had been stagnating over the past couple of years. And finally, Verizon is going to spend over $10 billion for the next 3 years to build and enlarge its 5G wireless network infrastructure. And this will allow it to compete with companies such as T-Mobile and AT&T. And also it will allow it to push more users to upgrade to unlimited monthly plans. Currently, about 61% users use unlimited monthly plans. In 2018, only 40% had unlimited monthly plans. So you can see that Verizon is on the right track with this. Next, we're going to talk about consistent dividend growth. So over the past 14 consecutive years, Verizon has paid out dividends to shareholders. For that time period, the average dividend growth rate was about 2.11%. And over the past 12 months, the dividend payout ratio was equal to 52.18%. Usually a good ratio is between 35 to 55%. So Verizon falls on the higher side of that spectrum, and that can really reassure investors that the company is stable and well established within its industry. Verizon's top competitor, AT&T, has a dividend yield of 6.86% and a payout ratio of 58.26%. This is higher than Verizon's dividend yield of 4.3%, but we believe that Verizon's potential for share price appreciation makes it a favorable pick over AT&T. One other thing we're excited about for Verizon is their current acquisition of TracFone Wireless. TracFone Wireless offers prepaid cell phones, which is a completely different market than Verizon currently operates in. Prepaid cell phone users typically appreciate the freedom associated with not having a plan and not being tied down to one cell phone. And they currently have about 21 million consumers to their name, which Verizon hopes to pick up. And This will essentially expand their portfolio, expand their market base, and hopefully expand their net income and revenue as well.
So moving on to the valuation, we used a dividend discount model with an average dividend growth rate of 2.34% and a weighted average cost of capital of 4.15%. And this helped us find Verizon's intrinsic value of $140 roughly. So currently Verizon stock trades at about $58.39. So our valuation would give it an upside of 58%. And it also suggests that the company is undervalued by the market.
We also performed a Monte Carlo simulation to see potential future valuation of Verizon in the short term. In the 1 year, we see a future return of 1.14, which equates to a future price of around $67. And in the 5 year, we see a return of 1.49 and a future price of around $87.60. This is right on line with other analysts' high target value for Verizon. So we feel comfortable knowing that Verizon has the potential for high growth in the future years.
So moving on to the competitor analysis, within the telecom services industry, Verizon faces competition mainly from AT&T and T-Mobile. So AT&T currently has the highest market share with 39.9%, but Verizon is not far behind. And T-Mobile's market share is quite low, but its recent acquisition of Sprint and its commitment to building the nation's best 5G network have really set it up to compete with Verizon and AT&T. So as competitors invest more money into catching up with Verizon's network capabilities, it's becoming really important for Verizon to find ways to differentiate itself. As we said before, the company has been putting a lot of money into its 5G technology. So if they are successful with that, it will help set them apart by becoming the first full provider of 5G services in the United States. And that should help them poach customers from T-Mobile and AT&T and expand their customer base. And next is the beta analysis. So Verizon has a good beta of 0.52. That means that it's less volatile than the overall market. And that on average, when the market increases by 1%, Verizon's price will increase by 0.52%. AT&T has a higher good beta than Verizon, as well as T-Mobile, but AT&T's bad beta of 0.8 makes it a riskier asset to hold in the case of a market downturn. So that's why we prefer Verizon over AT&T and T-Mobile.
A few risks do exist that we do want to consider before making the purchase of Verizon. And these risks are coming straight from Verizon on their self-reported 10K. The most important internal risk we saw is the high debt level that Verizon currently has. They currently have over $118 billion in debt outstanding. But a lot of this is due to their current rollout with the 5G and their 5G implementation. In fact, just recently, they took out $25 billion to pay back this debt, or start paying back this debt, rather, over the next few years. So that's something that they are currently working on, and that should be contained in the future years. The most important external risk that we want to consider is the regulatory risks associated with the telecom industry. In fact, just recently, Europe put into effect new policies for how these telecom companies are regulated. Verizon quickly changed their policies and changed the ways that they operate to fall into these policies and make sure that they're still seen well by the regulatory makers and the policy makers. But it is something to keep in mind going forward. Of course, policymakers want to make new laws all the time, so just something to keep track of.
So these are some of the reasons why we recommend buying Verizon stock. We want to thank you for watching our presentation.
Thank you.
Thank you so much, Jackson, and thank you so much, Ralph. Very good presentation. And now, any questions from the judges?
Sri, would you like to start?
Dean, sure you're
Sure.
muted.
Sorry, you are muted.
All right, thank you. First of all, thank you. Well-written report. One of the questions I had was, as looking at, could you talk a little bit about how you arrived at weighted average cost of capital of about 4.15%. Just to, walk me through the process of how you arrived at that.
Okay, so for the valuation, we used for the weighted average capital of 4.34%. We used a cost of debt of about 3.5% and a cost of equity of about 4.93%. For the weight of debt, we had 33.84% and a weight of equity of 66.16%. And finally, the risk-free rate was about 1.749% on the day that we calculated it. And the market return was estimated to be 8.51%.
So just help me understand that cost of equity. What drives that to be only, what is it, 4+%? Is what you said?
Cost of equity was about 4.93%.
Okay. All right. I'll leave it at that. Thank you.
Charles, did you have a question?
Sorry, take myself off mute there. Great report. Really enjoyed it. You did a nice job characterizing some of the regulatory risks on the European continent. I was wondering how you would characterize the U.S. regulatory environment for the telecom sector and Verizon in particular.
Yeah, well, I would say that the regulatory environment in the United States is pretty amicable with Verizon. They've been working pretty closely. I think the FCC is the governing body there. They've been actually working pretty closely together to make sure that policies that they put into place are in line with Verizon's future plans. I think just in 2018, actually, when they came up with a new set of plans regarding local government setting up payments for 5G implementation, actually Verizon helped create that policy with them so that in the future, they'd be able to set up these 5G towers and 5G infrastructure in places that they would be more better for them to reach more people. So going forward, it seems like Verizon has a really close relationship with these governing bodies, and something not really to worry about too much going forward.
Thank you.
Todd, it looks like you got some earbuds in there. Are you with us to ask a question?
Can everyone hear me now?
Yes.
Yes, we can now. Great.
Okay. So I do have one question. Great outline, great summary of the report that you all compiled. I was curious about, maybe this is more of a strategy question, but how have you seen this company affected by COVID and their response to it? Do you think it'll change the way that they do business going forward?
Well, in 2020, phone sales were down because of COVID-19. Other companies within the telecom industry were also affected by that. The most affected was AT&T, and they actually reported a net loss. So moving forward, Verizon has really put a heavy focus on 5G, and mostly with their consumer group. But there is also opportunities with companies, and Verizon is currently working with Amazon and Microsoft to find ways to implement their 5G technology in things such as factories, so that people who work in factories can, for example, robots in factories that are building and manufacturing things can be put on these 5G networks and infrastructures.
Very good.
Thank you, Todd. Jackson and Raphael, I do have a question. It's kind of a softball, but one of the charts that you showed was talking about consistent dividend growth. And it was interesting how you presented it. I've never seen a chart. Usually you see a mountain chart when you're showing growth, right? Meaning you go left to right, 2016 to 2020. And the chart that you actually showed had 2020 on the left. So it actually showed it. What my first impression was that dividends were not growing. They were actually decreasing. Was there a reason that you presented it like that? I've never seen that.
There wasn't a specific reason for presenting it like that. We just thought it would be. It was when we inputted the data in there, it's just what it looks like, and we thought it was pretty self-explanatory because we put the dates at the bottom. But I see why it would be actually better to see it, to do it the other way.
Nice job, guys. Dr. D?
Thank you so much. And students, I think this gives you a very good lesson that someone else might read your reports and presentations even more carefully than you are.
Hey, Huja, can I ask one other question quickly?
Yeah, sure.
You know, Andrew and Raphael, your recommendation is a buy. And can you help us understand the key drivers to that decision of a buy? Because when I look at some of those, it didn't help me with that. So maybe you can help convince me why it's a buy recommendation.
Yeah, sure. So, I mean, for me, there was a couple of main reasons why we chose Verizon, and one of those was the telecom industry. Of course, it's not a very volatile industry. It's high growth, and it's seen a lot of growth in the past years. And then, especially when it comes to growth, we love the 5G implementation that we're going to be seeing. Verizon is going to be the biggest one over the next few years, and that we've seen cash flows increase, and that's something that we think is going to keep increasing over time too.
Okay. All right. Thank you.
Thank you very much. And thank you for the question and the answers. And Jamie, would you please move on and start the video of the second asset, which is Intel.
Hello, my name is Remington Conti, and the stock that I am recommending is Intel. So Intel is a multinational corporation which is headquartered in Delaware. It is the world's largest semiconductor chip manufacturer on the basis of revenue. And it's actually the company that designed the x86 instruction set CPU architecture, which is basically what is used in most PCs today. Intel also supplies processors for computer manufacturers such as Lenovo, Hewlett-Packard, and Dell. Intel manufactures devices which are primarily related to communications and computing. The company operates through 5 business segments, which you can see here. But overall, the majority of Intel's earnings derives from their client computing and data center operations. So what attracted us to Intel was that it's currently priced near fair value, and they also just released their 11th generation of CPUs on March 30th. Intel is also diversifying into the discrete graphics market, which currently there are only 2 competitors, NVIDIA and Advanced Micro Devices, or AMD. And Intel also has a beta only of 0.68, which indicates that overall it is less risky than the market on average. Their managers are also very forward-looking, investing in future technologies such as the Internet of Things and autonomous vehicle navigation, which will ensure that the company remains competitive for decades to come. And Intel's profit margin is just over 25% at 26.84%. The recent increase in demand for microprocessors fueled by remote working and online learning has led to a global shortage, and that's one that Intel is poised to benefit from. So as I said, Intel's management team is very forward-looking. They're currently investing in technologies expected to be in high demand in the near future. Intel has also shifted its focus from high-end consumer products to more mid and low-range products, increasing their customer base. And Intel is also investing in field programmable gate array, which is a technology that will dramatically increase performance at a lower power and with lower latency. And so the emerging field of the Internet of Things, since it's emerging, has exponential growth potential, and that's something that Intel is looking to position themselves as a primary facilitator in. And then due to the coronavirus pandemic, Demand for personal computers has dramatically increased, while at the same time supply levels have decreased. And with this new normal, this demand is not expected to decrease anytime soon. With their recent acquisition of Mobileye, Intel is clearly determined to penetrate the self-driving vehicle market, which is currently dominated by NVIDIA and Qualcomm. Now for the bearish sentiment. The NVIDIA's acquisition of ARM Holdings increases the competition in the server, storage, and networking markets, which also gives NVIDIA the ability to compete with Intel in the CPU industry. The NVIDIA-IBM alliance has also increased competition in the supercomputing industry, and it's just another example of competitors teaming up against Intel. Since its release, AMD's Zen architecture has put both increased pricing and efficiency pressure.
$2 billion. This indicates that Intel was not only able to maintain, but improve and adapt during these unprecedented times due to the COVID-19 crisis. The full year report also exhibits R&D of 19.7 billion gap, which was the same in 2019. Potentially, we could see a decrease in R&D next year if Intel decides to outsource some of their processing chips for manufacturing. Now we're moving on to business challenges. Starting off with Intel's internal factor. Intel Corporation is an American multinational corporation and technology company who is also one of the world's largest semiconductor chip manufacturers. With manufacturing being one of the forefronts of Intel's revenue source, they've had some noteworthy complications with manufacturing. Starting off, in 2016, Intel's manufacturing of the 10 nanometer chip had trouble keeping up with demand and resulted in Intel shipping out facilities 10 nanometer chips. A more current issue is that Intel lost its 15-year partnership with Apple, partly due to the fact that Apple wants to produce its own processor. In addition, Apple's new manufacturer is supposedly more advanced. Next, with Intel's external factors. Intel is a technology company that manufactures various communication and computing devices. Technology is forever evolving and expanding, so the competitive market is one of Intel's biggest external factors. For example, Intel is one of the leader manufacturers in central processing units, also known as CPU. As of recently, companies like AMD and Apple are expanding into the CPU market, which could result in revenue loss for Intel. Let's go ahead and dive deeper into Intel's external factors by discussing Intel's competitors. The first one being Advanced Micro Devices Incorporated. Advanced Micro Devices Incorporated is a multinational semiconductor company. AMD is a more device-specific company who produces more affordable processors than other competitors. The current revenue is $9.7 billion and the market capital of $92.169 billion. AMD has developed a new CPU and RX 6000 graphics that have reached the market. They continue to develop and design new semiconductors, which is leading up to a promising future. Our second competitor is Apple. Apple is a global technology company who designs and manufactures everything from smartphones, laptops, tablets, and other various devices. Apple became the first US company to reach a market capital of $1 trillion in 2018. In just 2 years, it doubled that to $2 trillion. It is clear that Apple has tremendous growth power and continues to show that. By ending their partnership with Intel and developing their own CPU, known as the Apple M1. After analyzing the data versus Intel's, there's one major difference that stood out, which was Intel's prices are notably lower than their competitors. This could be because Intel has better long-term performance than short-term. And you can see that data on the right-hand side of the screen. Now to wrap up with our final recommendation. With our last price at $64.87 and a one-year target estimate of $65.60, our recommendation is to hold.
Sri, did you have some questions for Remington and Grace?
Yes, I do. Thank you, John. Again, thank you for the presentation, the report. Really looking at, appreciated the comparison between Intel, Apple, and AMD. Can you talk a little bit about why Intel is being valued so low? Whether it doesn't matter whether you look at the PE or price to cash flow. Can you help me understand why the market is valuing them so low compared to the others, and your recommendation is still a hold?
I'm thinking that they're showing the ratios. They both show that the company is undervalued, like through the PE ratio, the cash flows ratio, all of them are showing it's undervalued. And also, I think it's partly due to the manufacturing issues that Intel has had. Everything else, they're pretty much at the forefront, but manufacturing seems to lead them down. So I consider this a more long-term investment than short-term, showing that the undervalued of this company.
What does that mean, bro?
Thank you.
Yeah, any other question?
I was curious, looking at the beta of the company compared. Was that compared to the technology sector, or was it compared to the overall market?
Yeah, the technology sector beta was I pulled off of NASDAQ and some credit rating agencies. And yeah, it just shows that Intel's beta is relatively around half.
Hello?
A typical technology sector company would be.
Okay. Have you all looked at how NVIDIA and AMD have done over?
What was the end of the question?
Todd, sorry, I think we missed the second part of the question.
Okay. The Teams keeps coming in and muting.
Maybe.
Todd, if it helps, can you please type in the question in the chat so we can see that?
No longer muted again. I guess I'm just saying, why has NVIDIA gone up like 1,400%?
Sorry, we still missed the second half of the question. Can you please type in the question in the chat part so everyone can see that on the screen? Thank you, Todd. So Grace and Remington, can you see the chat part? The question was, why the NVIDIA gone up so much and Intel has not followed? NVIDIA was up 1,400% and Intel is only up 125%.
Well, I do believe that the company is still undervalued, as is near fair value. And it also might have to do, I haven't looked at NVIDIA's financial statements, but may have to do also with, in part, the investing that Intel has been doing in terms of getting their foot in the door for the next major revolution, being the Internet of Things, and positioning themselves possibly using their liquid assets for that as opposed to reinvesting in the company.
Thank you. And Charles and John, do you have any question?
Charles? I don't know what happened to Charles, but so yeah, I have a question. First of all, Remington, you look tremendous in a suit. It's been a while since I've worn one myself, and for 23 years, every day I've worn a suit and a tie. So you look great, and Grace, of course, you do too. My question, there's been a lot of talk recently about, raw materials shortages when it comes to the, semiconductor market and with plastic and, really since the beginning of the year. Just wondering if you have any thoughts about that as far as, I know you mentioned on the bearish side that, hey, they continue to delay their product release dates. That to me sounds pretty significant, and just wanted to know if you had an opinion on that.
Yes, well, absolutely. The coronavirus has not left the technology center unaffected, obviously. So maybe not necessarily due. I know the delays in their 7-nanometer node process is more due to actual issues with the photolithography, with the light rays. You actually have to take certain wavelengths of light, and just all the secret sauce that goes along with that. Yeah, so essentially, I think the industry has not remained unaffected by coronavirus. That's mostly been the effector of the supply side. And like I said, the demand side, not only is demand skyrocketed, supply levels have actually decreased in that same time frame. So it's like a double negative, or essentially it just builds exponential demand potential for the company, which is ultimately good. But yeah, right now I think it's more filling the orders instead of looking forward as much. They're just trying to keep up with the demand at this moment.
All right. Thanks very much, Remington.
Thank you.
Appreciate it.
Charles, do you have any question?
Yeah, I'll ask one question related to the balance sheet, and I know you addressed it in your written report. Just curious about the increasing debt level over the past couple of years. Any comments on that?
Yes, that was certainly one aspect that I noted in the bearish sentiment. I didn't, in fact, investigate. I would need to investigate further as to why they decided to accumulate so much debt, but it was about 33% increase over the prior year. And off the top of my head, I would assume it's something to do with their supply levels, just keeping liquid assets available for the company to basically weather through the pandemic through 2020, through last year.
Just out of curiosity, comparing their balance sheet versus their closer competitors, how does their debt level stack up relative to the others that you looked at? If you know.
Right. That would, as I said, that would have to be investigated further, as I did not look at the competitors' balance sheets, but it could be on par with others, and it actually could be less.
Thank you.
Thank you very much, all the judges. And Jamie, would you please help us move on to the third presentation, which is to present the Home Depot asset.
My name is Justin Ure. My analysis partner is Gage Stevens, and today we'll be presenting an analysis of Home Depot stock. We'll now look at the industry analysis of the home improvement sector as a whole. We'll begin with the main catalyst for growth in a booming real estate market. With home values at all-time highs and supply lower than ever, and a demand that's higher than ever, spurred by the COVID-19 pandemic as people leave crowded cities and smaller apartments To move into more spacious single-family resident housing in the suburbs, home builders are building homes faster than ever, trying to keep up with the extremely high demand. It's estimated that over 1.1 million new homes will be built in 2021, and that new home sales will rise an additional 9%. When you also consider the point that it is relatively still cheap to purchase a home because of low interest rates, the home craze will not stop, and the new construction will continue as supply stays relatively low. Home Depot sits at the forefront, ready to capitalize on all of the new home building and craziness in the real estate market. The second part of the industry analysis for the home improvement sector needs to be looked at in terms of the shift to online, this massive shift of online that's happening in retail in general. Home Depot have a great website where you can see pictures of products you're going to purchase and videos of products that you would like to purchase online. It's an easy to use website. They offer curbside pickup through the COVID pandemic, and they've also offered free delivery on a lot of their products because, I mean, let's face it, during the beginning of COVID, they've dealt with it well because people didn't want to go out to brick and mortar stores in public and shop themselves. They wanted to order it online. This is why you've seen Amazon their stock price, at least, has shot through the roof, and their sales have shot through the roof. However, there's another side to this on this shift to online, and that is that the home improvement sector in general is not threatened by these giant retailers. You can't rent tools from Amazon. You can't buy bags of concrete on a pallet from Amazon. You can't buy tons of lumber online from Walmart, or from Amazon. You have to physically go to the store. These contractors that are building these new houses will physically still go to the store. They want to pick it out. The customers want to see the product for themselves before they put it in their cart, and then they want to leave with it. There's no way that these giant retailers can match what Home Depot provides.
In the home improvement sector, we really have two companies that are at the top. It's Lowe's and Home Depot. And so today we're going to talk about why we think Home Depot has the upper hand here. And in doing this, we're going to talk about the dividends as well as the short interest. And then we're going to get into some of the profitability and efficiencies with the companies. And then lastly, we're going to get into the financial statements as well as the valuation of the company. So starting off with dividends, we see that Home Depot's dividend is currently 2.17%. Now this is double the industry average at 1.01%. So this is very impressive for Home Depot, and we as investors like these higher dividends because it can be looked at as more guaranteed. Another big catalyst here for Home Depot is that their annual dividend growth rate is 21% over the last 10 years. This is very important, and we as investors love to see this. This high annual growth rate is a key signal in a healthy, growing company. Next, we're quickly just going to touch on the short interest of Home Depot. And when doing this, we really have two different ratios that we use. One is the short interest ratio. And for this, we really want it to be under 4, and 4 is just a industry benchmark that we use here. And then we're really good on the percentage of short holding, which is 0.74%. And we want this number to be under 10%. So this is very, very strong. And what this essentially means is just that there's not a lot of people out there betting against Home Depot, which is what we want to see. Next, we'll get into the profitability and efficiency part of this presentation. And this is where Home Depot really excels. If we look at their net income margin, we see that Home Depot's margin here is 9.13% compared to Lowe's, which is just 4.96%. Next, we look at the return on invested capital, and this is a 5-year average. Home Depot has a return on invested capital of 36.6%, which is more than double Lowe's. So what these numbers essentially mean is that Home Depot just has a really good management team. They've been able to cut costs from anywhere from the technology to anywhere in between the supply line. These numbers are just very impressive, and we like to see this as investors, and this definitely gives Home Depot the upper hand in profitability and efficiency. All right, so next we're going to use statistical analysis to take an in-depth look at some of the financial statements of Home Depot. So we first see that they have an annual increase of revenue of 7.3% over the last 10 years. This is very impressive, and this is what we want to see as any investor investing in any company going forward. So an increase in revenue is a must, and we see that here in Home Depot. Next, we look at the current ratio of 1.2. Now, this is what we want to see with Home Depot. This essentially means that they're able to pay off their short-term debts without any problems. Next, we look at the average free cash flow, and it has increased at a rate of 10% a year over the last 5 years. This is also very impressive, and this is what we love to see as potential investors. This free cash flow can potentially go on to increase dividends, which they have done, or which leads me to my next bullet point here, which is share buybacks. Which Home Depot has actually done at a constant rate of 4.2% a year over the last 4 years. As investors, we love to see these share buybacks because it raises the stock price and it creates value for the shareholder. So with a mix of these numbers and ratios, we see that Home Depot does have healthy financial statements.
For the final part of this stock presentation, we want to give the valuation of the Home Depot stock and a little bit of a future forecast. So currently, Home Depot has 1.7 billion shares outstanding, and their free cash flow per share averaged out since 2018 is about $10.77 a share. And Home Depot has been amassing cash and growing their cash flow over the last 10 years. But since 2018, we took an average of about free cash flow has grown about 18% on average since 2018. That's averaged out. And the free cash flow yield, we did this at a percent of 7%. However, we're expecting about 5% going forward, and that's just being conservative in case the housing market and the supply and demand problem were to balance out just a little bit. And basically, when we grow free cash flow per share of $10.77 by the 18.35% average that free cash flow has grown, we get a stock price by 2027 of $493.60. In a quick summary, we want to talk about the 4 main points we'd like to leave you with through this Home Depot stock analysis. The first one is that can't be understated is the booming real estate market and the supply and demand problem that will continually stimulate the building of new homes. The second thing is Home Depot's efficient management style, more efficient than any of its competitors. Finally, the rising rate of the free cash flow is unreal, and that has led to Home Depot paying back their investors with rapidly rising dividends and purchasing back 4% of their shares, and we think they'll be able to continue that easily with that amount of cash flow. Considering this, Home Depot is a strong buy and will provide long-term growth to its investors. Thank you.
Sri?
I'm having trouble. Unmuting seems to be the trouble of the day today. So, I'm going to let I'm going to formulate my question. Maybe I'll let somebody else go first, and then I can come back to you in a second here. So.
How about you, Todd?
Great presentation. Love Home Depot. I feel like I'm partially responsible for the stock price rise, or a big driver of it anyway, personally. But what do you think in terms of growth going forward for the company? Are they just going to start building more stores? I mean, how does Home Depot continue to grow post-pandemic, do you think?
Can everyone hear me?
Yes, and also I'm typing in the question in the chat box in case someone want to see that.
Okay, great. So as of right now, Home Depot is only in, they're mainly in the U.S. and now they've expanded to Canada and parts of Mexico. But really, they do plan on branching out internationally, which will definitely bring in more money as well. And as far as I know, we really preached on this was the housing market boom, and we really want to rely on this just for Home Depot as a source of extra revenue and gained revenue going forward. But this is how they would grow their revenue and profits in the upcoming years.
Thank you.
Great. Charles, do you have any question?
Yeah, good report. Like Todd, I personally have helped the Home Depot increase in value significantly over the past few years. But your report is fairly glowing, talking about the strength of the housing boom, a lot of the characteristics that are driving that right now. What could go wrong? What risks do you perceive out there that could derail this? What seems to be on the surface an opportunity with a lot going forward, but what risks do you perceive that could derail the momentum here?
Right. So we didn't list the risks. We were told that you guys were given our report, and we had risks that were directly off of their 10K. So some of the main ones that we have written down here is cybersecurity, for one, with this massive shift to online, and they have multiple clients online. So cybersecurity is a big risk there, but we see this industry growing as well, and we look at cybersecurity as a risk that really any company in the online market would have to deal with, and we also see delivery times as a big risk with this shift to online as well. We'll look at Amazon, for instance. They have 1-day delivery. So Home Depot really has to just be able to keep with this, with on being. Right. So Justin, would you like to add anything?
Yeah, I want to add one other main risk, and that's the housing market would turn out to be a bubble, and it does collapse, which, I mean, it is a little bit of a bubble. But I mean, if that happens, that's a risk for the entire market.
Right. So like I was saying, sorry, I lost track there.
So I don't see that happening.
I'll just add it. I lost my train of thought there. So what they really have to do is just crack down on their delivery times. Like I said, we see Amazon, getting this 1 and 2 day delivery. So if they really want to remain a competitor, they have to get their delivery times down.
Okay.
Great.
Just to follow up on Justin, I appreciate your comment about the housing market. It certainly seems like, I don't know if I'd characterize it as a bubble. Certainly some indicators that would suggest that. You don't see that as a risk. We've gone through a housing boom bust cycle within the past, 10, 15 years. What is different about this housing boom than previous ones? And how did this sector perform during those previous downturns?
Yeah, so I actually looked briefly on that before I did this presentation, and I saw that during the 2008 period specifically, their revenue, did go down compared to previous years. Not that much, like we're talking 6 and 7%, but the whole market collapsed. The whole market, and so when you look at other companies during that same time frame, their revenue went down about the same amount, and you would think that a housing, company in the housing, that's their sales based off the housing market. A lot of it, not all of it, but you would think that company would suffer more severely, and they did not.
Interesting. Thank you. Appreciate the response. Great job.
Sri, did you have a question? Then I had one to finish up.
Sure. I want to just follow up on the housing market, but slightly different take on it. We just pumped in a few $1 trillion the last couple of years into the economy. Clearly, can you talk a little bit about the potential inflation risk? Because one of the reasons attributed for the housing market is being the low interest rates. So could you talk a little bit about what you see and how that's going to, have a potential impact on Home Depot.
Well, one, we look at inflation, and we look at real estate kind of as a hedge to inflation. Seeing that, we do expect that the real estate market's going to do really good in the upcoming years. So that would mean investing in real estate would give a higher return than what inflation would be. And this would go on to.
I'm going to pause you there. I'm going to push back a little bit here, Gage. So if we are seeing a significant demand in the housing market, if interest rates go up, help me understand how would that serve as a, if the demand will decrease from that, how would that serve as a hedge? Help me understand that.
So, I mean, so basically owning a home, the home values are always going up. That's the reason. So you hedge against inflation because, your rate that you are locked in at, doesn't change with the, raising rate. And the other thing I was going to add to that is, this is about the whole housing market thing in general, is through COVID, people, were home a lot and they fixed their own stuff. So it's not just the new construction that Home Depot is getting a lot of their sales from. It's also people that are going to the store and wanting to do home improvement on their own. And I think COVID has kind of gotten people into this more do-it-yourself type thing instead of hiring someone to do everything, because people have had more time at home. And so I think they'll also, the sales from that are higher than they were, 5 or 6 years ago.
Got it. Thank you.
Yeah, and guys, I'd just like to kind of finish here with you guys as a softball. One of the reasons why this is an interesting case is because all of us know Home Depot so well, right? But one of the things that I would just caution you, I just heard a comment which was home prices always go up. And I can assure you, I see Todd smiling. Anyone who lived in 08 in the first 3 months of 09 until March 9th of 09 can assure you that home prices do not always go up. So rising interest rates is going to be, absolutely going to be a suction on the real estate market whenever that comes 2 or 3 years from now. So, but here's the layup question I want to just finish with. I found it fascinating that you talked about short interest in the stock. Obviously, over the last 2 months, there's been a ton of interest thanks to companies like GameStop. And I'm just wondering, was what happened with GameStop, did that influence you at all as far as preparing your report and including short interest? Thank you.
I don't think so, but now that you say that, that was definitely interesting situation, what happened there. I think it was more so just, what we learned throughout this class, and this was a main point that Dr. Dong really harped on. So that's really why we, included short interest there, and just the numbers from an industry benchmark aspect look really impressive, not only for Home Depot, but really that sector overall.
Great. Thanks, guys.
Just a quick follow-up. The short interest was a part of the course content that I require the students to look into and to investigate. Yeah, without further questions, thank you so much, Team 3, and that was a very good presentation. Jamie, can you please help us move on to the last presentation so we can make sure we're on schedule? And the event is about to conclude around 7:20, 7:25.
Hi, my name is Finn Vandenhandel, and together with William Calcutt, we will be talking to you about why you should invest in Corsair. Corsair is a leading global manufacturer of high-performance gear and technology for gamers, content creators, and PC users and enthusiasts. They develop and manufacture anything from award-winning PC components and peripherals to premium streaming equipment and smart ambient lighting. Corsair delivers a full ecosystem of products that work together to enable everyone from casual gamers to committed professionals to perform at their very best. They are recognized in the tech hardware and semiconductors industry within the technology sector with the sub-industry of technology hardware. The company was founded in 1994 and is based out of Fremont, California. Our recommendation is for you to buy this stock for four main reasons. One, being that it is undervalued. Two, being that it has diversified revenue coming from multiple different segments of the company. Three, being that they recently IPO'd on September 23rd of 2020, and since then we've seen over 125% increase in the stock price. And fourth, being that they're a market leader and there are many future upsides to investing in the stock. We believe that Corsair Gaming is currently a great investment opportunity with a large potential in the next few upcoming years. Within the last year, we have seen a significant rise in the gaming and PC products due to the global pandemic that has kept millions of us inside and at home more than ever before. We believe that this is an opportunity for Corsair to grow even more in the near future and that investing in their stock would be profitable. The levered beta is around 1.2, which shows that Corsair is more volatile than the entire market, which means that if the market continues to rise, Corsair will outperform it. Our predictions show that at the end of next year, the stock price will grow at 16.8% and see a 9% growth rate after that for at least 5 consecutive years. The current stock price is currently at $32.60, and the end of year target price is approximately $45, and the 12-month target price is $55. Corsair's current price earnings ratio is 28.6, beating the industry average and being lower than 33.58. The positive price to cash flow was 4.3 times less than the industry average, and the positive price to free cash flow ratios were 3 times less than the industry average. Corsair operates in 3 different segments, one being streaming peripherals. This includes anything from streaming accessories, cameras, microphones, to streaming lighting. Components. This means just different types of components for PCs and gaming builds. We also found that most gamers put together their own PCs, setups, and also buy components on their own in order to upgrade their systems and keep them updated. And lastly, systems, entire gaming systems for PC users and gamers, which also includes software oftentimes from Corsair that will allow gamers to be able to control everything on their setup from one user interface. Revenue from multiple segments. In 2020, the gamer and creator peripheral segment gross profit was $189.7 million, with an increase of $108.4 million, while gaming components and system segments gross profit was $275.7 million, with an increase of over 92% year over year. For 2021, the revenue is expected to increase by 7%. This is impressive considering that the coronavirus definitely inflated sales over the last year, but is still maintaining that sales revenue and is still projected to grow even after coronavirus is thinning out.
Corsair is still a newly public traded company, considering that their initial public offering occurred in September of last year. Since that time, they've experienced substantial growth, and they also operate in the technology sector. And the technology sector has been on a trend of rapid growth since 2015, and they have had major influence in the S&P 500 index. Currently, in the S&P 500, 33% of the companies are from the technology sector, and that is expected to grow to 40% by the end of this year. In regards to investment risk Corsair may deal with, we believe that these 3 are the most challenging they may face. Firstly, they have a dependence on third-party products. Corsair does not produce all the computer hardware that is installed into their PCs that they sell. Therefore, they rely on other companies that they have no influence over and depend on them to frequently release new high-performance computer hardware. Second, are challenges in innovation. Their innovation is based on their ability to add new features or product lines to the market that they believe consumers will desire. This is a significant challenge because of the capital requirements for research and development and the manufacturing of these products. Additionally, new competing products are introduced at a rapid rate into the market, and technology is unceasingly changing and evolving. This requires Corsair to anticipate new technology, market and consumer trends, and gaming requirements, which can lead to challenges. Lastly, unexpected declines in other influential industries. The possibility of gaming, streaming, and esports not growing as expected or possibly declining creates a substantial risk for Corsair. These aspects have been growing at an exponential rate over the past decade and have contributed to the growth of Corsair. However, Corsair has no influence or impact on whether or not these aspects will continue to grow. Outside of the pandemic inflating sales of this industry, there have been other contributing factors to Corsair's growth. The video game industry has played and will play an important role in the sales of Corsair's products. There are now 2.7 billion gamers globally, and this is expected to rise to 3 billion in the upcoming years. On top of that, the video game industry increased by 9.3% in 2020 and is now estimated to be worth around 160 billion. This industry is forecast to keep growing and have an estimated value of 260 billion by 2025. Possibly the biggest factor that has contributed to the growth of Corsair is the explosion of esports and streaming. In 2020, across all streaming platforms, there were almost 28 billion hours watched. A lot of that has to do with competitive video games, and they continue to integrate into the mainstream and pop culture. Total esports viewership is expected to grow at a 9% compound annual growth rate until 2023, with an ending value of 646 million, which means it will have doubled its value since 2017. Initially, esports and streaming were not taken seriously by most of society, but as time goes on, that opinion is changing as investors realize its potential. Now, how is the future a contributing factor? Well, there was a recent survey conducted in the United Kingdom and the United States, which asked children from the ages 8 to 12 what they wanted to be when they grew up. Almost a combined 50% wanted to be a streamer, a YouTuber, or a vlogger. This can be contributed to the factors previously mentioned. As strange as it may seem, this is the future, and it is an industry that is here to stay and is continuing to grow every year. These professions will require products that Corsair is providing. And what Corsair did early is they realized this trend and they invested into sponsoring streamers and esports teams, which has allowed them to create a competitive advantage and grow their market share. This type of investment has already paid dividends and will continue to do so into the future. As you can see, this is their market leadership across their product categories, where they're majority in first or second within their industry. In conclusion, the reason you should buy Corsair and invest long-term is that they are maintaining continuous year-over-year growth in sales. They are undervalued based on their financial ratios. They have multiple business segments, growing revenue. They operate in one of the strongest industries, and they have other industries that safeguard potential market volatility and contribute to its growth.
Thank you so much. And before the judges start to ask questions, I would like to remind it would be very helpful if you can help at the same time fill up the grading form and send it my way so I can start the calculation and make the announcement of the 2 awards. And any questions from any judges?
Sure. Why don't I start off? First of all, I want to commend the team. I think you did a fantastic job on this report, really bringing some key elements about the company, but also the demographic shifts and how they have done. So really congratulations to all of you. Question I have for you is that clearly this is an emerging market that's pretty competitive. Can you talk a little bit about their innovation strategy and their investments in R&D to stay ahead of, or to compete with the Logitech, which is their major competitor?
Well, as you know, they focus on gaming and streamers and stuff, and that product, which is different than Microsoft and that. Logitech is their main competitor in the gaming peripherals, but Logitech doesn't offer computers or monitors, which is something that makes them different. So Corsair is a one-stop shop compared to their real competitors, because the big ones like Microsoft and Dell, they're probably not going to catch them, but they also don't target their audience. Microsoft and Dell, they have very niche gaming product lines where Corsair doesn't, and that's their future plan is just to keep growing their market and investing into the gaming peripherals and stuff like that.
Okay, thank you.
Charles?
Yeah, you touched on it in your business challenges. I wonder if you could, and this is not a company that I'm all that familiar with. Talk about the controlling single shareholder and how you perceive that. Does that present some additional risk to this stock that really is pretty new to the market? We don't have a lot of trading history with it.
Yeah, so having a single shareholder obviously could be a challenge because if his interests don't line up with the market or consumers, then that can obviously lead to detrimental effects down the line. But he seems to be fairly involved in the company. He was also the founder, so I think he wants to continue to see growth. And they've had the same strategy for the past 5 years or so, and it seems to be paying off so far.
What is his percentage ownership?
I'm not sure, to be honest with you. I don't know the percent ownership.
I think it's in the 90s. He almost owns all of the shares.
Todd, did you have a question?
It looks like he owns 67% of outstanding shares with a limited partnership. Right. I guess my question is, following on the Dean's question of R&D and continuing to, build a presence within this industry. I would think that since there's technology is moving at a fast pace and these gamers want ambient lighting and all these other things behind them, new microphones, new mouses, new keyboards, all this other stuff, that they're always having to continue to heavily invest in R&D to stay competitive. What is that going to do to their margins going forward? Is it going to maybe differ or cause a great change in the margins going forward, other than maybe what's expected in forecast? And how so?
In regards to that, I know this past year, 2020, they paid $200 million in loans and debts, which I would imagine a lot of that has to deal with R&D, and their gross margins still increased by around 27%, and so did their adjusted operating income. So they've already factored that in, and this past year they've paid off almost all of their debt, and they still had profitable margins or an increase in those.
All right, guys, I will, first of all, I want to say kudos to you for not picking a mainstream company. The fact that, that it's got a market cap of 2.8 billion, whether you consider it a small cap, mid cap company, whatever, I consider it small cap. And you guys took risk, right? I talked before about Home Depot and how, and Verizon and Intel, those are things that we all know about. So congratulations and kudos to you for taking on that risk. And so here's my question, are you guys users of this product, of these products? And, I guess where my question's coming in, hey, why did you choose it? And are you actually users of their products?
Yeah, actually, I just built I didn't build it myself, but I just placed within the past 6 months. I went to a site and built my own computer with recommendations from my friend who works at Google. So I used some of the hardware and the cooling systems that Corsair provides. And I also looked into some of the pre-built computers they had when they released the new graphics cards, but they were overpriced. As most people know, the part markets for computers are super inflated right now, and it's one of the first times in the history of computers that it's actually more cost effective to buy a pre-built computer than to actually build it yourself. So, and I've known it from like playing video games and like the esports stream or the esports boom and stuff like that. So that's how I knew about it.
Yeah, and I personally have not bought any Corsair products, but I have different types of systems. And I think to me, the main reason it was interesting is kind of the whole streaming industry being so new. And definitely with COVID, I mean, I think any type of, people who are into the gaming industry have noticed that since COVID, I mean, a lot of components are on back order. It's been hard to order monitors, to order CPUs, and so the entire market, it just seems, has gotten so much bigger within the last year, especially because of COVID. And so that was kind of sparked my interest in doing it for our report. It's a good investment with the growing industry.
Thanks, guys. I think there's a great lesson there where, hey, as Warren Buffett always talks about, you invest in what you know, right? What products that you use. And I think that's exactly what you've done here. So, Dr. D, I'll throw it back to you.
Thank you so much. I really appreciate. And by the way, I have received the scores from 2 judges. I appreciate if the judges can send me the scores so I can put together. And any other questions from the judges?
I guess my last question. Corsair, again, grew or IPO'd at a great time when COVID, esports is at all-time high. Everyone's attention is focused on it because they can't do much else. Do you think there's a big risk when everything goes back to normal that everyone's attention goes other places and then you see sales decline as a result from that? Do you see that as a significant risk?
I don't see that as a significant risk because it's not just a U.S. market, right? Gaming in like Southeast Asia, like it's part of their culture. Like famous like athletes and like singers here, that's their celebrities in like South Korea. Like their professional video game players marry like the famous actors or actresses. So it's a global thing. It's not just like the U.S. market. So it's like I said, it's 3 billion gamers in the next couple of years. It's it's bigger than sports and everything.
Very good.
Yeah, that they're diversified, as far as that they sell entire systems, that they have their own software in order to control everything and the peripherals. I think that definitely helps them to kind of minimize that risk with COVID sales declining.
Okay.
Thank you very much. Any other questions? Great. So at the time, as we're waiting for the scores, as I am adding up the grades and pending the announcement of the 2 awards, why don't you 2 students share with the judges any questions you have regarding the financial industry, regarding how you want to utilize what you have learned from this course, from the Student Managed Investment Fund in the real financial industry practice. Any questions from you students to the judges? Thank you, dear judges. And I have collected all the scores from all 4 judges, and I am ready to announce that the 4th stock pitch competition of the K. Tiedemann School of Business and Finance Merrill Lynch Wealth Management Center. The Best Presentation Award will be granted to the group that presented Corsair. Congratulations.
Nice job, guys. Congratulations.
And the Best Investment Analysis Award belongs to the group that presented Verizon.
Very good job.
Very good job. Congratulations. And thank you so much, again, the judges and dear students, for your effort in putting this great event. Thank you.
Before we close up, Hujan, I just want to thank Dr. Dong for his timeless effort into guiding all these students because I think your work is really greatly appreciated. Thank you for guiding these students year in, year out. I truly appreciate that.
Thank
And,
you so much, Dr. Sundaram.
And last but not least, again, our staff members, Jamie and Terry, who have been integral in supporting, the whole process and being here, much beyond their time for the day. And finally, I want to close out by saying, for those of the students who have participated in it, I'm glad you took the time. I know it's a lot more time than you would have invested in just doing a test, but the payoff is significant. And as Mr. Decker talked about, it is not only the opportunity to understand and look at a company, but also building network. And now you have showcased your talents to a group of folks that are going to be recruiting in the future, but also being critical mentors for you. So please keep that and take advantage of that.
Thank you so much, Dr. Sundaram. And everyone, thank you for your time. And we will send out the results of this pitch competition, and we'll follow up with you regarding the real purchase with the Student Managed Investment Fund. Thank you. Have a nice evening. Bye-bye.
Thank you.